Good morning, this is Drew Erickson back again talking about money, not math. And today I'm continuing the conversation I had yesterday about 401ks. Do you know the rest of the story? Today with specific examples or from the book that I'm reading on 401k loans, 401k taxes, and 401k required minimum distributions. Okay, so as a reminder, for those who haven't seen my previous videos, for today's conversation, if you like today's conversation and didn't see yesterday's, or listen to it, I recommend going back and watching that one too, because it's a good preface to today's conversation. But the book I'm reading is The Missed Fortune, Dispel the Money Myth Conceptions, Isn't It Time You Became Wealthy, with Douglas Andrew. And so, as always, I'll read a couple of parts from the book, give my follow-up opinions or reactions to those parts in hopes that I bring you value. So basically, like I said, getting into it, the first portion is about 401k loans. So I find that many people use 401k loans, whether it's for emergencies or other opportunities. I've heard many different examples, but not everyone's aware of how exactly they work. So I wanted to highlight a portion from the book and provide a little reaction to that. So what Douglas says is that many 401k plans allow individuals, and sorry, before I continue, keep in mind that when I say 401k, that's just one type of traditional group retirement plan. They work the same way from a tax perspective as 403bs and things and other things like that. The lettering and the numbering and things like that it's just a different type for where you work and the type of industry you're in. So like a public sector is 401k, sometimes the health sector is different, and if you work for a school, it might be 403b. So just something to be aware of. They don't all work differently necessarily, but there are sometimes some differences. Anyways, so he says many 401k plans allow individuals to borrow on their 401ks. However, certain conditions must be met in order to avoid a 10% penalty. So what he's getting at there is that if you pull money out of your 401k before you're 59 and a half without meeting certain conditions like medical hardship and things like that, you have to pay a 10% penalty on top of the income taxes that you're going to owe, because those are tax deferred accounts. Traditional 401ks are. Roth 401ks are not. So continuing what he says, one of those conditions is the loan must be paid back systematically, so on time and regular, just like a loan from a bank, according to a schedule that starts immediately. The interest charged on borrowing from a 401k can be credited back to the person's 401k, so you are in effect paying interest to yourself. Keep in mind, it's not like paying interest in an advantageous way. It's really hopefully a wash at best, because you're also losing out on the money, how that money would have compounded had it been invested in the market. All right, so it's not like you're getting the interest and the growth in the market. You're paying interest to yourself in order to hopefully make up for the compounding within the market. Where like a year like this year, where the market's up like 18%, might not work out. So he says this can be an attractive feature if timely payments are not made or deducted from your paycheck. Then any of those funds that were received in the form of a loan convert to a distribution and are taxed in the year it was converted. Therefore, a 10% penalty tax may be assessed on top of that if you are under age 59 and a half. So essentially what he's saying is, if you meet certain conditions and are able to take a 401k loan, the advantage is you have access to that money, so it can be helpful. And when you pay that money back, you're paying yourself interest, so it will hopefully make up for the lost compounding or growth that you would have received by being invested in the market. The disadvantages are the fact that you have to pay that money back systematically and regularly in order for the loan to stay in good standing, and you cannot leave your job. So if you change companies or don't make payments on time, they are going to charge you a 10% tax penalty if you aren't 59 and a half, and you're going to have to pay income tax on that money. Okay, so those are things to be aware of. There are pros and cons of making that decision, which is why I often encourage people to have savings outside of their 401k, not to depend on that as their liquid assets, because there are stipulations around how it can be used. All right, so moving on to 401k taxes. So as we know, if you invest in a traditional 401k, you are deferring the tax. You aren't paying the tax this year, you're deferring it until you retire. Okay, so But so what we want to think about when it comes time to take that money out is how we want to take it out and when. All right, so there's many ways that we can leverage your low income or low tax years. All right, so what I mean by low income is, let's say it's the first year retirement and you're not pulling out and you don't have, so you just retire from your job and your income is going to be much lower. It might be a good time to distribute a lot of your 401k assets that are deferred, bite the bullet and pay taxes this year, so that you don't have to worry about paying taxes in the future when your income may be higher from other distributions. From a low tax perspective, it might be smart to pull your money out earlier rather than later, because we know what our taxes are this year and we may not know what taxes might be in the future. Right? So two examples going on in society today. One, you have certain politicians talking about raising tax rates to 60-70%. Well, if you're currently at a 20-30% tax rate, you may not be at the 70, but you might be at a 40. All right, so you're automatically going to have to pay more in the future than you would if you pull that money out today. Second, we have to understand that even if politicians don't change the taxes, our current tax structure is set to sunset or end in 2026, which means that we'll go back to 2017 levels. So if you were paying more taxes in 2017 than you are right now, that means in 2026, 27, you're going to be paying more taxes than you are right now too. So it might be better to pay taxes this year rather than then. All right, so those are just a couple side notes, and now I'm going to read a couple of examples that he provides. Keep in mind that this book was not written this year. It was written in early 2000s, so the tax bracket examples he uses aren't accurate anymore, but the example conceptually still holds. All right, so what he says is, many couples fail to take advantage of low tax bracket to reposition qualified funds. Qualified funds is what he means is like 401ks and things like that. Anything that's in a retirement account that has tax deferred status is considered a qualified fund. It's qualified for tax advantage treatment, so-called tax advantage treatment. For instance, they may be in a 15% bracket with their taxable income $10,000 below the 27% threshold. This means they can add $10,000 of income while still remaining in the lower bracket. In this case, they could reposition $10,000 of qualified funds at the low 15% tax rate. Their tax rate may be higher in the future. If they don't reposition now, that opportunity may be lost forever. It is usually advisable to get qualified money out, taxed, and repositioned in a tax-free environment rather than leave it there to continue to compound the problem. All right, so something to keep in mind is it is possible, if you have like a traditional IRA that is tax deferred, to convert that money into after-tax Roth IRA money without having to pay the 10% penalty. As long as it stays within an IRA, you can convert it and pay the interest this year. So I understand I'm throwing a lot of details and ideas at you. I don't expect you to remember all of them. I don't always remember all of them by any means, but the point is, it's just things to think about and consider is, if you would rather pay taxes now rather than wait and defer the problem, there are options available. So I encourage you to have a conversation with your advisor, and if you don't have one, I'm more than willing to answer questions, or you can find someone that does, are able to answer these questions for you. So continuing on, here's a specific example he provides of someone he worked with. A 70-year-old couple came to me feeling so proud that during the previous 10-year period, they had reduced their taxable income by virtue of other deductions to zero. In other words, they had incurred no income tax liability for an entire decade from ages 60 to 70. However, this couple had substantial assets that were growing, tax deferred in their IRAs. When I showed them they could have transferred about $450,000 out of their IRAs during the previous decade and enjoyed the lowest tax rate of 15% federal tax, they were heartsick. Because they continued to postpone their tax and delay the inevitable, the minimum distribution requirements at age 70 and a half forced them into paying some tax as high as the third bracket, 31% at that time, which was 16% higher. So what he's saying is, because they kept deferring and deferring and deferring and deferring, they ended up finding themselves having to pay 16% higher taxes on some of their distributions than they had to if they would have taken that money out earlier in their career. So it's not always best to save money this year for taxes to defer it on the road, if you may end up paying more. All right, so continuing on, the next point I want to make is required minimum distributions. So what require minimum distributions, for those who aren't aware, when it comes to working with traditional group retirement accounts, 401ks, 403bs, SEP IRAs, things like that, from the day you start saving into your account, you don't have full access to that money without conditions and tax penalties until you're 59 and a half. At 59 and a half, you have complete control over how much money you want to take out and when, until you're 70 and a half. At age 70 and a half, the IRS steps in and starts telling you you have to take required minimum distributions because they want to get paid on some of that tax money while you're still alive. Okay? And so here's an example he's going to provide on how that works. If an individual does not begin withdrawing money by the age of 70 and a half, in accordance to the Internal Revenue Code's minimum distribution formula, the IRS will penalize that individual for not withdrawing those funds. The IRS would like to have some of the money out and taxed each year before the couple passes away so they can receive revenues during the couple's lifetime. It may be taxed a second time if not consumed as it transfers to non-spousal heirs. If an individual leaves the money in a qualified plan and does not make the minimum withdrawal based upon the minimum distribution formula, a 50% penalty is assessed to the taxpayer on the amount that should have been withdrawn. All right, so I'm going to say that again. A 50% penalty is assessed to the taxpayer on the amount that should have been withdrawn. So an example, if you're 71 years old, don't want to take any money out of your traditional IRA because you already have other income from other sources, you don't need the money and don't want to pay the taxes, but the IRS determines that you need to pull out $20,000. If you don't, they can tax you 50% of that $20,000, which is $10,000, a penalty because you didn't. If you don't pull it out. All right, so that's something to be aware of, required minimum distributions. So to follow it up, here's one more example he provides. Couples must pull out the fractional amount required each year so the money is generating tax revenue before they die. At first, this seems like a very gentle distribution process and the taxes may not seem significant. But as the couple continues their minimum distributions, they end up paying extensive taxes when all the years are totaled together, and the remainder left behind at death gets taxed as well. Estate tax if you qualify for the estate tax. I have repeatedly found instances in which a retired couple may pay more than twice the amount of taxes on their retirement plans if they string them out using the government's minimum distribution formula, rather than if they simply bite the bullet and pay the tax on the systematic withdrawal plan or strategic transfer over 5 to 7 years. Often after careful analysis, they may only pay 40% of the taxes they would have paid had they strung the withdrawals out over their lifetimes and transferred the remainder to their heirs. This is especially true if they reposition their after-tax distributions into tax-free environment from that point on. All right, so I know that was kind of a convoluted conversation today with a lot of in-depth details. Hopefully, conceptually, it provided value to you in the 3 different categories we talked about, meaning how 401k loans work, how 401k taxes can work, and when it may be best to pull out and when it may be best not to pull out your money or convert that money to after-tax status. And third, how required minimum distributions work. All right, so thank you so much for taking the time to listen or watch my conversation today. I hope it brought you value. If it did, please comment to let me know your thoughts, or if you have questions, or click like, or even better yet, share with a friend that you think would also find value from the conversation. Thanks again for taking the time to watch or listen. I hope you have a great rest of your day and enjoy your weekend. Bye.